Now, here's a covered calls trade that I did, which was in Honeywell. Now, this is Honeywell. I bought it when it was undervalued. Now, I'm actually thinking of selling, but I'm thinking of selling like a portion so I can put that cash into another investment. But I will still keep my shares in this because I still think and I still see that it's a great company. For now, though, what it shows in the charts, as you guys see right here, it's the similar situation with what Starbucks is at, but this shows a little more sign to go up. Now, I'm not saying that it can go up, but it shows a more probability to continue somewhat up than compared to the Starbucks. Why? Because when the price is not too overstretched, it is overstretched, but it's only been overstretched for 4 days. Usually, an overstretch is when it's been like that for 2 weeks or a week and a half, because it's like an engine. Like it starts to become exhausted as time goes on, and the more it goes up, the less time it needs in order to reverse and come down to go up again. So that's why uh, there is chances of going up, but it's the chances of it going up in this is less than for the price to go down. I will find a farther expiration date to give it time to go down, which I see by probability it will, but this time I won't do it with at the money calls because I'm not that bearish for now. So I will look for options out of the money for this. Remember, I do at the money calls if I'm very bearish, but because this share price is not completely overstretched, I'm not as bearish despite a strong resistance, overbought, far from the 20 moving average. It's not very overstretched, so it's not as bearish, but it is bearish regardless. It's more probability for it to go down, not to continue up. So what I did was I decided to look for a 42 days expiration with a option actually out of the money, as I said. And this is at the money. It's just out of the money, and I chose this because of its delta and also its premium. I saw the premium equated to 2% of the entire net sale, and its delta is 37, and it has 42 days ahead. So there's room for it to go down, but not as heavily compared to others like Starbucks, as we saw. So I will sell it here at the mark price of $3.90. So you can see it's $3.90. I will fill this option for $3.90, and when it gets filled, I'm just going to simply wait for a few weeks to see what happens with the option very closely. So look what happened. This stuff can happen, guys. This is real. Like this is why I said like there's possibility. That's why I wasn't very bearish that it can go up because it hasn't been completely overstretched. But there was less probability for that to happen compared to the price staying still or going down. But that possibly came true on my opposition, and the shares did skyrocket in, which negatively, of course, impacted the short call. But even though there's still time in our option, I need to now close it because it's obviously the option is way over exceeded the 80 delta, which can negatively impact our entire profit and loss within the investment because now it's almost behaving completely like 100 shares that I'm losing, which we don't want that. So you can see that the option that we sold just a few days ago now has an intrinsic value of $17.90 where we bought it or we sold it for $3.90. So that it's deep in the money. Look at the delta, it's 91 delta. So by now, our option has way over exceeded 80 delta, which is a sign to close it since there's now way too much risk that it can negatively impact our entire investment in Honeywell. Where of course, we're still very positive yet because look, I told you I bought it cheaper. Now it's at a higher price. I'm still making $65.88 per share, but because of the option over exceeding 80 delta, the option is now impacting it -$1.15.12, which is why net in total we're still gaining those $65.88, even though the share price is gaining $81.01. So because of this, I do need to sell it because even though it's a small portion, it could get worse because it's a good company. It can keep going up. So it starts to behave exactly as it is to hold 100 shares, but sort of shorting it negatively. If whenever the price goes up, it starts to lose more value. So that's bad because if the shares go up, every dollar will most likely be losing $100 per $1 move like the investment we have, but in the other way because our investment because it's going against our investment. And worse is that we lose when it moves like that because we are writing a call. Again, writing means we're selling a call. we have an infinite loss because the option can go as high as it wants. That's why you saw the max loss was infinite. But again, you guys aren't idiots. I'm not idiots. I'm not gonna let this expire when the delta is more than that, and like I'm not gonna sit there and watch it, lose so much value when I know I can close it. So we'll close this option for a debit of $19.03. Ouch. But that's part of it. That's an expectancy you should have in this, and this is why you need to have 100 shares, because it's a small portion to your 100 shares. That's why you need to have 100 shares. You shouldn't do this, which is basically selling naked. I mean, if you're selling naked, that means you don't have the 100 shares. You don't have the capital to offset this, which means margin call. So you're not, we're not those people. Hopefully you're not, don't do that. But now, we have a loss, and of course we're going to have to find another call further at another expiration date to collect a premium that can offset the current loss, which is $15.12. That's our entire loss, because our loss is not $19.03 because we still collected the premium. The premium is $3.90. So it would be $19.03 minus $3.90 equals $15.12. So again, even though at the price right now, which was here, I'm still not very bearish because the stock isn't completely oversold with the resistance on it. But it has completely flown so high in the share price, which always leads to a drop, especially a 90-degree fly. Always leads to a correction. But for this, I mean, I'm looking for a call that has a premium more than $15.03. So similar to cash secure puts, as I've explained in cash secure puts, whenever your first put is a loss, you need to make sure that the other premium you collect from the other put has to overexceed the loss of the premium you had to close on the previous put. But in this case, you need to look for a call option to sell that has a premium more than the call option you just closed for loss. So in this case, what's the premium here? It's $15.03. So it has to be more than $15.03 to collect a credit. And also in case the price doesn't, if the price goes up but it doesn't go up as much, which means that our options don't expire worthless, we're still able to collect a little bit of credit because there was a bit of more premium compared to our complete loss. So, the strike that I chose was $195. It's in the money, but again, it's the same thing as CSP, which is cash secure puts. I'm not looking here for an out of the money or out of the money. My entire goal here is just to get a premium to cover the entire cost of the previous call I just lost. So I don't mind if it's in the money or the delta's high, because usually those premiums in the money still have also a bit of extrinsic. So this option is 38 days ahead, which is good enough for our criteria too. Now I would choose to sell the option at the mark, which is $15.27, which more than enough covers our remaining loss in total of $15.13, which we actually collected credit net. Now we just simply monitor the trade for the upcoming weeks. So you can see that that in 30 days, 30 days has passed, and damn, the price went up. Damn it. Our call now is a bit more in the money, and we have to roll it again because there's now 7 days left. This is a possibility, guys. Like the price can, that's what I'm saying. Like in calls, when it's a good company, not a lousy company. Like sure, in a lousy company, that's very, very low chance. But in a good company, anything that's expensive can be more expensive. Why? Because it's a good company. They're going to be doing good if it's even expensive, but it will come back to value as people realize the reality when they see others selling. Even though they don't know why they're selling, they just sell because the others are selling. That comes to a catalyst. But remember who controls that? The market maker. So you can see that the option that we sold went up because the stock went up during this month, but we didn't lose that much. We just lost $1.43, and that's very low compared to the entire covered call. So entire covered call loss. So I will now have to close this trade for a loss, and I'm gonna have to enter another call that expires more than 30 days ahead, but that it can more than enough cover the now remaining loss is $16.56. Why? Well, because our other option that we closed lost $15.13, but because now we have to buy this call option back. Now the call option's worth $16.70, where we sold it at $15.27. So the difference from here to here is $1.43, but that's a debit. We have to pay it because it's now higher now. So $1.43 added by the loss we just had is $16.56. So I'm gonna have to close this trade at the mark, which is $16.70. Again, it's a little misfortunate, but it was within the possibilities that we saw that the price can stay in the money, and because there's no guarantee that the price could fall when I sold the second call too. So this is just part of the game, guys. After I close this, I will sell another call at a further expiration date. So I did that. The premium. So as you guys see that the premium is, so the $197.50. So this is the third call, right? I just closed the second call. Now I'm gonna open the third call, which is 43 days ahead. Now I'm gonna choose to use this strike because it has a premium of $17.42, which is definitely more than enough can offset the remaining loss, which was $16.56. This is actually incorrect. Yeah, this is incorrect. Sorry, guys. Okay, so at this strike price, you can see that it expires 43 days. So that means our criteria, because it's more than 30 and it covers our remaining losses, 16 cents and $16.56. And we're actually going to make a net credit when this expires worthless of 72 cents. So that's great. We're going to end up actually making a profit, even though we've been taking a blow of a loss for since November. It's now December. It's only been like a month, but like a month and a half. Because this option expires in December. Oh no, not December 4th, in January, the 29th of January. So you can see, yeah, I made a mistake again. My bad, guys. This is 86 cents. I was doing the calculations. So I decided to sell this. This is how it looked like. Of course, I'm selling it for $17.42. Multiplied by 100, that's a max profit of $1,000 you can see that if you grab $17.42, which is the total premium, subtracting that by the current loss that we're taking, which is $16.56, net in total, you're actually going to get a positive 86 cents. Multiply that by 100, that's $86 that we'll collect as a credit. So now you can see that, okay, the price has dropped. Of course, because nothing can last long, guys. The stock market and any market does not move in a straight line. That's not real. It's based by emotion. People have to have reasons enough in order to maintain the price, and especially when there's surges of buying. That surges of buying is based on people buying before and seeing them buy, and they buy again because they don't base their buying based on facts. They base their buying based on other people. So when they see slightly facts that are irrelevant, they get scared because they don't know the facts of the company, because they're just listening to someone else. So that's why the price will drop more. And of course, the person leading that drop is the market maker. So again, in overall, the market does not move in up and down patterns. The price here has dropped since we entered the third call. However, the call isn't at the money yet, but it's still in. But I won't close the option yet because I do believe it has a bit of room to go to hit a strong support after such a strong rise. It needs to have a strong enough reason for it to go up again by hitting any of the areas that are close to this horizontal line, which or also the 100 moving average, which are both somewhat close. So the current option we're holding is actually $5.27 away from out of the money intrinsically, and that option has a premium right now of $6.97. So you can see that we're actually making a profit because we sold it at 17 cents and 40, something like that, and now it's at $6.97. But I won't close it yet because that part of the premium, that portion of that premium is made up by extrinsic, and extrinsic always dies at expiration. So the valuation within the contract, because I do see it, I am bearish because I do see it to fall down because it needs to have a strong enough reason to offset this rise. Needs to drop to another level of support where it can support it to, or at least give it an incentive to go up. So as you can see, I was right. The price did go down. The price actually needed to get close to the 100 moving average, which is what I expected. And the great thing now is that the call option is actually out of the money, which its premium has been completely depleted, or as I would like to say, obliterated. It had a remaining now of, the option is now 25 cents. That's nothing of just extrinsic because it's now out of the money. It doesn't have any intrinsic. Because remember, the call option that we sold was $197.50. Now the current stock price is at $196.52. That's almost $1 away from at the money, basically. So it's out of the money by $1. So because of this, I'm actually going to close the position manually, and I won't let it expire because it's still very close to in the money. So I don't want to take that risk if if the price for some reason just a few minutes before the close goes up significantly, making this candle now a hammer candle, which can definitely happen. I've seen that. So because of that, I'm not going to take any chances. I'm just going to close the position for maybe with the fees that's like 27 cents, but I'm fine with that. That more than enough covers our entire loss, because remember what I said, if I collect $1742 and minus that by $16.56, our net credit is 86 cents. But if I subtract it by the debit we just paid, which was 27 cents if we put the fees, this would still be positive. If you grab 0.86 minus 0.27, that still gives you a net credit in total with your loss 59 cents. So let's talk about the summary of what we did with this. So after battling the price rise from rolling the call continuously, we were able to actually end up with a net credit for all of 61 cents before fees. So we closed the third option when it still had a remaining value of 25 cents, which was its extrinsic, but in overall that didn't affect much with my credit. And I'm happy that I was able to recover it, because it ended up with a slight credit, which pretty much I was able to bring my P&L and entire investment a little higher, or where the current share price is at right now, like as nothing happened to the investment. So not in total, even though I lost previously in my covered calls, I was able to recover that loss and actually make a profit, to the point where that skyrocket share price is reflected now with me gaining back that gain in the loss, is like if nothing happened to the investment, like it did that gain with the skyrocket. So of course, when I'm talking about theirs, because the price went down, it would be acting as if the current share price is gaining at this price. So let me talk about every single step we just did. So all the orders we executed. So the first one, of course, was that we decided to short a call at the strike price of 190. So that was the first option that we did in this covered call for Honeywell. And in that option, we collected $3.97. Then what happened is that we had to close that first call for a net debit of $15.13. So that's already our loss. We lost $15.13. Then what I decided to do was roll that call and find another call, which is our second call, to collect a premium that's more than our entire loss. And I was able to get a premium of $15.27, and that more than enough covers our first call for a credit. The fourth thing, which was that on the third call, I was then filled at $16.70 compared to $15.27, which of course incremented our current loss, which was $15.13, because I had to buy it back higher. Because remember what happened here? The call, I believe, the call went, the option went up within just 7 days until expiration. So I had to make a decision. So I had to close it for a loss. Now the remaining loss in total was $16.56. Added, because I added the remaining loss for the third call by the remaining loss for the entire covered call, would have gave me $16.56. And with that loss in my mind, I then had to look for another call option more than 30 days ahead. And I had to look for a premium, and I found a premium of $17.42, which was of course more than enough to cover the remaining loss of $16.56. So that fourth call then got bought back to close it at 25 cents. So in total, from collecting 17.42 cents minus 25 cents that we had to buy back, net we credited in total $17.17, which more than enough covers the loss that was remaining, which was $16.56, ending up with a net credit of 61 cents. So here's the entire summary. So first, please only use covered calls when you own already 100 shares of a good company that you intend to sell, actually, but you don't mind selling it right now, but you do want to sell it at a higher price. So this strategy, again, could be tricky, because there is a probability, as I saw and as you guys see and as I've explained, that you can still lose much more without rolling it anymore. Because when the call is way too deep in the money, like way too deep, meaning you see the current share price is beyond and far away from that strike price, then you see it's almost now very, very hard to get it back close to that strike price, because a stock will always increase in the long run, and its share price and perimeters as the intrinsic value keeps increasing, because they keep making more and more money in the company. So their valuation goes up, and their valuation is the intrinsic value. So there can be a probability, like always, for the price to go so high that the next correction that comes doesn't even get close to your strike price. Then then you would have to close the covered call for a loss, because the only really way a price of a company goes down significantly to hit your strike price, so it expires worthless, is really if there's a recession if there's a recession anticipation within the market, which is something very rare. Like that's something that happened this year. No one could have predicted that, but otherwise, that's why I don't use covered calls as much. I use it a few times, but I don't do it a lot because I try to diversify with it with other type of strategies, and there's a chance, like always, a price that's way up can still go up. So you need to, and that's why I've said to you guys, like, remember when I talked to you within stock trading or even within option trading, like you're gonna be, well, the option trading you're in overall, but it's the same. Like if you're in an uptrend, you're gonna be doing more long trades than counter trades. Like you're gonna be entering more long trades than short trades because you have to be trading within the trend. It's gonna be something that's gonna happen majority of the times. It's gonna go up by significantly in value. But in downtrends, you have to be more short than you are than long because the trend is going to go more down because it's been going down ever since to gain a benefit in that. Like why would you be expecting for the price to bottom? Of course there's expectancy, right? Like my job to do is not to predict a bottom, but is to likely have a probability to have a bottom and base my trading on whatever market condition it's at and benefit from wherever price it goes. So no one has like, you know that's why I try to diversify with other strategies. There's a chance, like always, that the price can still go up right when it's already expensive. So you need to just best use what you can see based on a probability measure where the stock can go. No one has a full certainty to expect a sharp price move. You can only best use what you see in perimeter where the price can likely go. So with this, use covered calls responsibly again. There's an abundant amount of other strategies in this option courses. You don't have to just use covered calls. You don't have to just use even cash secured puts. There's countless of other strategies where you guys don't even have to do this. You guys don't have to own 100 shares. If there's many other strategies. You don't have to own the stock or anything like that. If you can't use covered calls, no worries. There's so many others. You don't even need to use covered calls because there's way too many other strategies that are similar to benefiting, even get a more profit of expectancy per trade because you're trading within the trend, but in covered calls you're not trading within the trend. So but use it if you can handle it right. If you have the capital, the resources, and the expectancy correct in the stock where you can handle the worst case scenario, because when you can handle the worst case scenario, you're definitely able to adapt in a lot of many crazy situations that will happen in the market. Like I guarantee you that. Like if you can handle the worst case scenario that you can find and anticipate the worst case scenario, congratulations guys. Like seriously, like if you have that, like you're now a professional trader. That's what professional traders do. They handle the worst case scenario and they still benefit of what comes out net in total. That's your job. That's the only thing you should be doing to benefit whatever the market gives you. If you're in a downtrend, a lot of people say like, oh, I'm going to do trades going up because I like going the market going up. No. I don't care if the market goes up. I benefit when the market goes down, goes up, goes sideways. I don't benefit. I make money regardless wherever it goes. So it's having that mentality and also that expectancy and that way of managing things. So if you can handle the worst case scenario, you're able to then adapt to a lot of many crazy situations that will happen in the market. But of course, anything that happens in the market, a lot of people say that things that will happen has happened before. Not necessarily. It's happened, but it's what I like to call it, which is similar to what I can't remember if that was by Jesse Livermore. That or no, I think it was Mark Twain. Right? I don't know if I'm pronouncing his name wrong, but I think Mark Twain said that he said like the market does not repeat itself, but it rhymes itself. That's what you should have. So that's it for covered calls. Hopefully you guys can understand that. If you don't, please repeat it. Again, there will be many different examples throughout trades executed within live that you guys can see, so you guys can have more material to understand this better. In other ways, though, I'll see you guys in the next video.